The housing market is one of the most important metrics for investors and economists to monitor in order to determine the overall health of the economy. The housing market plays an especially large role in determining whether or not a recession is on the horizon, and it can also offer insight into whether or not certain sectors are outperforming others. For example, if you live in an area where new construction has slowed down due to a lack of demand for new homes, then that could be indicative of broader economic issues. In this video, I'll give some tips on how you might be able to bet against housing markets and other real estate investments like REITs, real estate investment trusts. What is to bet against the housing market? When you bet against the housing market, you're betting that prices will fall. So how do you make money off of this? Put options and call options are two ways to do so. A put option gives the buyer the right to sell stock at a certain price by a certain date. In contrast, a call option gives the buyer the right to buy a stock at a certain price by a certain date. This is also known as being long. You can buy or sell either type of option. If you're selling, it means that your goal is for prices to rise so that your position expires worthless, thus making money from those who bought it from you. Short or buy put options on a specific stock. You can also buy put options on a specific stock, which means you're betting that the stock will go down. The price of a put option premium is based on the strike price, expiration date, and volatility of the stock. As with call options, this premium can be calculated by using several online tools like Finviz or Optionetics. Invest in an inverse or bear real estate ETF. To invest in an inverse or bear real estate ETF, you must first find one. There are several ways to do this. Look at the top performers of the day on a site like Yahoo Finance. Then look at the index they're tracking, like S&P 500. From there, search for inverse or bear ETFs and compare their performance over time with that index's performance. Use Google Search's autocomplete feature, type in inverse E, to find popular inverse or bear ETFs by market capitalization and other factors. Use sites like Morningstar and Bloomberg to see what funds are available for purchase in your country of residence and compare performance among those funds across years, months, and days. But keep in mind that not all funds are tracked by these sites. Short or buy put options on and real estate ETF. Shorting an ETF is a way to bet against the market. You can short any ETF by selling shares of it, which involves borrowing them from your broker and then selling them at the current market price. If you make money when the stock falls, you'll have to pay interest on those loans as well as additional fees if you're shorting with options. More on that in the video. Shorting REITs can be tricky because of their structure. They aren't actively traded, so brokers aren't going to let you borrow shares from some other client's account and sell them yourself. That would be a fraud. In general, REITs are more liquid than other types of real estate investments. Their prices tend to be fairly stable overall. For this reason alone, it might not be worth buying put options on one particular REIT because there's no guarantee that its price will plummet anytime soon, and there might not even be enough time until expiration. If you're really sure about what kind of real estate investment will go down in value soon enough and want exposure without having to wait around until the expiration date, then buying put options may just be right up your alley. Short or buy put options on a specific REIT. A real estate investment trust, REIT, is a company that owns and operates income-producing properties. They're traded on the stock market just like any other company, but instead of owning shares of the REIT itself, you own shares in their assets. Put options are contracts that give you the right, but not the obligation to sell something at a set price by a certain time. For example, if you own one share of Microsoft stock at $100 per share and believe it will fall in value by June 1st, 2020, hypothetically, then you could buy a put option with an exercise price of $95 per share and an expiration date of June 1st, 2020. Your decision to either exercise your right or let it expire depends on whether or not your prediction comes true, or if something else happens before then. If Microsoft's stock price rises above $105 by June 1st, 2020, again hypothetically, then buying this option would cost more than simply holding onto your original position. However, if Microsoft's stock price falls below $98 between now and March 6, 2028, also hypothetically, then this option could save thousands compared to what would happen otherwise. In conclusion, there are many ways that you can potentially bet against the housing market. By using a variety of different strategies and investments, You can protect yourself and make sure that your portfolio is protected from any negative impacts this may have on it. That's it for this video. Thanks for watching.